Now, I would like to extend a very warm welcome to our panel moderator, Hall T. Martin, CEO of 10 Capital Network. Over to you, Hall.
Great. Thank you, Karen Deep. Thank you, Neil. My name is Hall Martin. I'm with 10 Capital, and I'll be moderating today's angel investor panel on how to raise funding online using special purpose vehicles. We have a great group of speakers today on the panel, and we'll have them introduce themselves one by one. First up is Joe Merrill of Sputnik ATX. Joe, can you tell us a little bit about yourself and your company?
Yes. Hey, happy to join you guys here today. Sputnik ATX is a early stage VC fund with an accelerator program. We are based in Austin, Texas. We tend to bring in two cohorts a year. Each has anywhere from 5 to 10 max companies per cohort. We do early stage investing and then follow on funding with our pro rata rights.
Great, thanks, Joe. Next up is Ben Davis of Midnight Venture Partners. Ben, can you tell us a little about yourself and your fund?
Hey, Hall. Yeah, Midnight's focused on consumer companies with existing traction that need functional resources to help them scale. We saw an abundance of capital in the market, but a dearth of funds that actually have the functional resources to help first time and second and on time entrepreneurs scale consumer brands.
Great. Next up is Rashad Kurbanov of Ionic. Rashad, can you tell us a little bit about yourself and Ionic?
Yep. Hi, everybody. It's a pleasure to be here, and I'm glad to participate in this panel. Ionic is a fintech platform we've built over the last 3 years, a pretty comprehensive set of tools for founders to raise capital online. The platform is built on blockchain. It's not cryptocurrency approach, but we're actually using the underlying technology to facilitate the capital formation flow of capital for individual and institutional investors.
Great. Next up is John Sechrist of Seattle Angels. John, can you tell us about yourself and the Seattle Angels?
Sure, thank you. I can't seem to turn on my video. Oh, there we go, start my video. Thank you. I run the Seattle Angel Conference. The goal of the Seattle Angel Conference is to create new angel investors and stronger startups. It's a program that we've helped get all the way from California up to Alaska. We do it twice a year in Seattle, where we gather 40 investors, produce an SPV, and then invest $200,000 into one of the early pre-seed companies that apply. And that program then has allowed us to spawn off 4 or 5 different angel groups or funds in the neighborhood, and we've been able to amplify our activities to almost 500 investors now.
Great, thanks. And next up is Matt Barbieri of WIS Group. Matt, can you tell us more about yourself and your group?
Sure, thank you. Happy to be here. My name is Matt Barbieri. I'm a CPA and partner at WIS. I chair the venture capital practice, which encompasses media, technology, and life science companies. We work with early stage enterprises all the way through the planned exit, potential IPO, sale to a SPAC, whatever the exit plan might be, or we might run it for a long period of time. And about 3 years ago, I decided to stop being one of the dumbest guys in New York and actually take an independence clause and determine to invest in some of these companies. So we've got a portfolio that we represent on the company side, probably in the 250 company range, where we offer our representation as a CPA firm. And on the investment side, it's a much smaller and focused group, certainly industry agnostic, but opportunity open. So that's a little bit about us.
Great, thank you. So first question up, and for those who are not familiar, we'd like to talk a little bit about what is a special purpose vehicle and how does it work. And we'll start off with Joe. You can talk a little bit about what it is and how it works at a high level, and then we'll go around the panel to see what others can add to that. Joe?
Yeah, a special purpose vehicle is an entity created generally to bundle a lot of investors so that it appears as a single line on the cap table of some other entity. You see SPVs are used when you're trying to usually take smaller investors in to write a single bigger check, but there could be other legal or tax purposes for creating them also.
Great. And Rashad, what would you add to that?
I mean, I think Joe covered kind of what SPV is. One thing I would say is that SPVs are actually very popular across the financial markets and capital markets. Probably a bit of a trivia for everybody that the vast majority of the U.S. corporation, actually all of them that trade on public markets, are owned by an SPV, which is the Depository Trust Corporation, and that actually allows, if you look at the cap table of large companies, many of them have just a couple of hundred, entries, and the vast majority of them are kind of running through the central clearing. And the SPVs do create an opportunity to, manage a large number of shareholders relatively efficiently by outsourcing that service to a third party. So it's not something, it's, for anybody considering an SPV as a startup, it's basically a well-trodden path, right, fairly well understood, nothing to be particularly worried about.
Great. And Ben, can you talk a little bit about how it works and for startup in the early stage and what you've seen done there before?
Oh, I would mention one thing, which is that family offices in many cases love seeing one-off deals. So the other use we see of SPVs is to have a one-off investment where the family office actually gets to see the deal before they firm commit on their capital. So as you see an increased rotation into alt assets, we're seeing a very strong rotation into alts right now. A lot of family offices don't love public, don't love other stuff, and they're going into alts. This is a vehicle you're going to see more and more where they're able to see the deal, say we love it, and put money in. You can negotiate terms specific to that deal, which is another.
Great, thanks. And John, what would you add to that so far on special purpose vehicles?
So special purpose vehicles are useful for a vast majority of the angel investors. Companies typically want to have a minimum check of 25K or 50K. 50% or 80% of the investors that are accredited are below 5 million in net worth, and so really shouldn't be writing those 50K checks by themselves. And so they are a very useful thing. And now that we have all of these different back-end mechanisms to support them, they become easier and easier to deploy.
Great, thanks. And Matt, what would you round
Sure.
out that we haven't covered so far?
I was just going to cover the perspective of people making investments into these companies. Typically, it's easier for me to get a yes into an SPV, which is a single family or a single group of people making investment into a single thing, than it is into a fund where it's a bit more blind and they're going in trusting whoever that fund manager is or whatever potential groups of companies they're going to invest in. So I think the increase in popularity in the SPVs is because of the specific look into the company that we're going to be investing in. And my background, I don't know if we're going to get into this, drives it to the tax consequences of this. I kind of have to always go back to my roots, but if we're going to cover that later, that's the main driver.
Great. Well, let's talk a bit more about that. What is driving the use of SPVs? Ben and John gave a few points there already, but let's go back with Joe. What do you think is driving the use of SPVs among startup funding today?
I think there's two things, primarily increased number of people who are interested in investing in changes in regulations that allow even non-accredited investors to put money into these companies. So like Reg CF now is open for SPVs as of March 15th. And so you have more interest from from prospective shareholders who can't write a check big enough to warrant a spot on a cap table per se. And so that's driving a big part of the interest is the ability to bundle a whole bunch of smaller checks. I also think that from the investor side, it can be easier to manage as an investor investing into an SPV where the rules may be different, and there could be tax considerations that you have as well. And on the tax side, depending on if the SPV is created as a company or an LLC, there are different tax considerations that benefit individuals differently, particularly family offices and their tax planning. And so using an SPV can help you in that way as well.
Great. And Rashad, what would you call out as a cause for the use of it today?
Yeah, it's an interesting question, right? So, if we look at what services does SPV provide, it's not just bundling the checks at the time of the investment, but frankly, every founder needs to think about the corporate governance over a longer period of time as the company exists. And quite often there are decisions that need to be made by a shareholder vote, or a certain number of people need to vote for a particular proposal. So when you think about it and you put yourself in the shoes of a founder, right, there's a lot of administrative burden that could be involved in getting things approved, or communication, etc. So the SPVs provide a very useful kind of mechanism to delegate or outsource that activity to a third party, in terms of if I can deal with just one or two entities on my cap table, it's easier for me to get the decisions done. It's easier for me to communicate, and whatever the consensus that needs to be built with the SPV members can be then kind of delegated to the SPV administrator. So I think, as whether it's the crowdfunding or whether it's more traditional kind of capital raising, administrative burden, right? So think of SPV not only at the time of investment and bundling the checks, but the benefits of that over a longer period of time actually make a significant impact and can be very beneficial, for anybody considering raising money online.
Great. And Matt, can you give us more detail there from your point?
Yeah, I think a lot of the driver, if you take the perspective of the company is going to have a number of shareholders, and there's investor relations, right? So first, if I'm going to have 1,000 different investors that I'm going to have to worry about communicating with, that's a task and that's a cost. That's an administrative cost and burden you've got to think about. And so it's significantly easier if I can deal with one SPV manager or a group of investments that are pulled together into one and have one form of communication. The other part would be the entity structure. If it's an LLC, which is flow through, the reporting mechanism that we use is a K1. And so you're preparing K1s for a potentially large number of investors, which can be extremely costly and burdensome from a time perspective from the people that are like key stakeholders to the business. So you really got to think about it on the end.
Great. And Ben, you made some good points a moment ago. What would you add to that?
Again, with family offices, we're seeing a lot of them that have invested in closed-end funds. And the entrepreneurs on the phone or on the call need to understand the model for VCs, which is an AUM fee, assets under management fee, and then a carry. And that AUM fee, let's call it 2%. If the fund raises the money and then takes 3 to 5 years to deploy the money, those are amounts they're paying to the general partner, the management team in the fund. And in some cases, we're seeing large family offices that have parked $10 to $50 million with a fund, and they're at year 5, and the fund has failed to deploy the money timely in their view. And so they've been eroding their potential returns the whole time. The SPVs are a solution there, where the family office knows when they're writing their check, it's because there's a deal that's actionable and you're closing right then. And so we think it's going to continue to rotate into SPVs. Great.
And John, what would you add to your statement a few moments ago about the trying to get more people into a deal?
So I think that the process of putting together very simplistic automated tools that support conversations between these people is very useful. Carta is doing some interesting things to lower the barrier to drive some of these things. The K1 problem that Matt brought up is really quite significant. And there turns out to be mechanisms by which, depending on which state you put which LLC in, you can reduce the fees and the associated K1s to a minimized number. And so there's a bunch of sharp edges around SPVs where you might have a factor of 5 different in cost and a bunch of overhead around K1s that are worth figuring out. But they allow this just a millionaire to write their $5,000 check and be part of a wide range of deals without too much trouble. But they also allow the fund manager that's the novice fund manager who's trying to build funds to actually gather groups of people and prove their ability to pick good deals and drive investment forward. So it's also an on-ramp not only for early angel investors, but early fund managers as well.
Great, thanks. So in the audience, if you'd like to pose questions, love to take those as well. We have a few already. First question to the panel is, what is the minimum investment you've seen go into an SPV if there's a 500K raise, for example? How far down can the investor go to put money in? Joe, what's your take on that?
if you're talking about like a 500K raise, those numbers could get pretty small. You could see $5,000 checks or something like that. Generally, like let's say the SPV is going to go in as an LP into a fund, right? Then you might see a fund that would have a minimum check size of $1 million, and they're taking, they're using an SPV to take checks that would be different, maybe $50,000 to $100,000 in the SPV. So it really just depends on the magnitude of the whatever it's being invested into, and what the limits and the thresholds are for that to be a fraction thereof.
Great. And if I go around the room, Rashad, what do you see out there? What are people actually doing with these for, say, 500K raises or even $1 million raises? What's the maximum minimum you're seeing these days?
I mean, honestly, maximum minimum, kind of varies, right, by, who's organizing, et cetera. I don't think that's, kind of, there is a rule. What I think becomes important is actually, I mean, when you get into that, this is where engaging securities attorney or somebody who understands capital markets and regulations becomes important. Because some of these SPVs can be considered an investment company, like Joe talked about, fund and feeding into a fund. Now you start getting into the look-through rules and, a whole bunch of other complexities. Tax is definitely consideration. So, I can appreciate, Matt's point around the tax. So it's not really the amount, right? I think the trade-off really is around what is the regulatory framework, how is it being structured, and getting some expert advice around that is important. Just kind of for, kind of side note, Republic, I think they form an SPV, and there you can go like $50, $100, and it doesn't really matter because they're just structured in such a way that it doesn't trigger any regulatory concerns. So long-winded answer, but kind of in summarize, you see a wide range, wide variety, but it needs to be structured properly, not to trigger, kind of potential regulatory issues down the path.
Great, thanks. Next question is, how much exposure do investing participants have with regard to the other people who are investing through the same SPV? For example, what if an investment by an SPV participant gets clawed back by a bankruptcy court? Matt, what's your take on that?
Oh gosh, that's a loaded question. That would be more for an attorney than me. I'm rarely at a loss. I'd imagine it was at risk to the limit of your investment via the LLC, hence the value of the limited liability company. But I don't know the answer to that. That's a pretty specific one.
So I guess you need to check with your attorney on that one, guys.
Yeah.
So next one up, Ben. Next question I found here that might be interesting is, as a follow-up, how do you market an SPV? What would you do to get the SPV out there to the network? Is it simple, hard, or what have you seen people do with that?
Hall, honestly, what we've done is we've formed and structured the SPVs around existing knowledge, existing network. And so it's often, the demand on a specific deal drives the creation of the SPV and then the terms thereof. Quickly, I'll touch on it on the bankruptcy thing so that entrepreneurs on the phone know. Your LLC's operating docs, either operating agreement or company agreement, will typically have a provision that says if you have a member of that LLC go bankrupt, then their interest is acquirable by the SPV, either at book value or fair value. So that's a quick answer. Again, you should seek legal counsel, but those as a template, typically have we never see one that doesn't have a provision like that in it. So.
Good point.
But there's a whole bunch of asterisks there.
there are, like, I've seen it where it's a buy-sell agreement. You're required to sell. There's other members are required to buy. The argument is over at what value. It's a hairy topic.
It is. Yeah. Next question for John is, can you talk about the cost of the SPV formation? There's many providers, but what have you seen out there are the ranges that people are paying to put an SPV together?
So we've been fighting that problem, actually, trying to figure out how to do that. We ended up using Assure for the last 5-6 years. Their basic service was $12,500 to put an SPV together. We're trying to figure out how to get the costs to be below 10%. for a $25,000 SPV, just so that people can do small ones, and that program won't work. And so we're starting to see things that are in the 2,500 plus 1% of whatever's raised kind of number, of various kinds. There's Loon Creek, there's Signal Rock, there's the Assure Labs program. Carta has a program. AngelList syndicates are running around 8,000. And so it ranges, something north of $2,500 all the way up to $15,000, depending on who you use and what you ask them to do for you. It seems like you ought to be able to get the simplicity of this down smaller than that. And one of the things that you can get in trouble with is if your investors are in many states, you have blue sky filings across many states. And so then your costs end up going up. And some states have particularly weird things, New York coming to mind on that one. And so you just have to be careful. You have to do a little bit of due diligence on your investors who are joining the thing to see what your costs are really going to be.
Great. And Joe, the next question is, as a founder, can my non-accredited employees invest through an SPV? Can I be their designated voter, or should one of them be designated their proxy? I guess the main question is, can non-accredited people invest in an SPV?
I'm going to go back to something John said, which is lots of states have different rules too. But at the federal level, and depending on the type of entity, like, is this a Reg CF SPV, in which case, yes, they could. Is this a Reg D underlying investment? No, they can't. And so you really need to understand both the jurisdiction where the employee is, as well as what the federal regulations are. And I would consult with an attorney and ask that question. Generally speaking, though, the Reg CF stuff, you could take a non-accredited investor. If it's Reg D, you can't. And check the rules, check the rules, check the rules.
Great. Next
And
question
I'd be
for
a little
Rashad
bit wary about, oops, I'm sorry.
Go ahead, Matt.
I was just going to add, I might be a little bit wary about being their spokesperson or advocate, considering the potential conflict of you representing the investment as well as the investee. I think that might be somewhat troublesome potentially, again.
That's what we call the bad deal put. We call that the bad deal put. If it goes poorly, they're going to call and say, I want my money back. If it goes well, it should have. So yeah, there's some practical wisdom there. Yeah.
I'm going to use that, Ben. I like that.
So there are two SEC exemptions that I think people should pay attention to in this context. One is a Reg D 504, which is the intrastate exemption. And in the state of Washington, for example, we have a intrastate crowdfunding mechanism where we can raise money from anyone in the state using that. And it has some advantages if you're local and doing local stuff. The other thing to look at is Rule 701, which allows contractors and employees to be accredited in that specific context. And they may be able to go in directly and you can form that. The hard part is whoever forms the SPV is the one that makes the offer and puts the registration of whatever SEC exemption you're going to use. So they have to think this out before they get down the road of asking people to get in. And most people are novices about that process. So then they get themselves tied around the default lawyer answer, which is Reg D 506B is the only thing you can do. Accredited is the only answer. Everything else should go away. And then you don't actually explore the other 11 options.
Yeah, and one other thing that I just kind of wanted to add, right? The regulatory environment is pretty complex, and we talk about kind of various regulations, crowdfunding, Reg D, etc. But we also need to keep in mind, the Dodd-Frank provisions, right? Which is around the number of shareholders the company can have before it becomes a reporting entity, etc. And the way kind of the rules are structured is that, the SPV actually counts as one entity on the cap table of the company, unless that SPV was designed or created with the specific purpose of avoiding around, that 2,000 shareholder limit. So if an entrepreneur is kind of considering like, I'll create the SPV to allow X, Y, and Z, right? It kind of gets to the point where somebody can say, well, look, hold on one second, right? You created this for some specific purpose, And therefore, from the regulatory perspective, we can actually look through and look at the underlying investors of that SPV and count them against your cap table. If they're non-accredited, the limit is only 500. So there are some inadvertent things that can happen, and probably the best practice is for the companies themselves not to form SPVs, not to be involved with that, and actually have a third party that does it, either investor group, angel investor group, group of family offices or whoever else, rather than themselves kind of stepping into that role, potentially exposing themselves to future issues.
Great. Thanks, guys. Next question is, can you speak more about the tax implications of SPVs? Let's start off with Matt.
Yeah, so it would be the structure of the SPV. And there's a lot of news out today about tax leaks and whatnot. And so the reality is the reason you would invest via an SPV for a tax purpose is to get flow through gains on the taxable income that you've created, one circumstance. Another circumstance, depending upon the entity that you're investing in, the SPV would keep the character of the gain or loss that is flowing through from the entity that it's getting. So in the early days, what I try to tell a lot of people is if you're throwing off losses, it might be advantageous to be an LLC in the early days to return losses to people that could actually utilize them, then converting to a C corporation and potentially starting the clock to be able to take advantage of qualified small business stock, section 1202. So the tax benefits would be that you keep the character of the income from the recipient. Now, the challenge to it, or the investment target, sorry, the challenge to it is the complexity of the LLC investment and the number of shareholders that are potentially going to be within this SPV. So it drags in the question of how small is too small with the investment. When you said, like, would somebody putting $5,000 come in? I don't know. It depends on the size of the investment in the SPV, because the administrative cost of dealing with that typically isn't great. And secondarily, I don't want to generalize here, but I kind of have to. They typically aren't people that can utilize the losses that are going to flow through to them anyway. So all that to say, there can be tax advantages. It's certainly worth something that's exploring at the early days when you're setting it up. And that's, yes, sir.
Great. Joe, what's your take?
There's one thing, and I think Matt said that perfectly. There's one thing I would like to add, which is you should consider secondaries with SPVs when you create them, particularly if you're buying into them, because particularly if you're buying into a really early stage company where you're 12 years away from an exit. And so, in certain SPVs, you may only be able to sell that to someone who's in the SPV vehicle, as opposed to like if you do prime trust or something like that, where you can sell it to any shareholder. And so you may have restrictions on a preference for an early exit. And so in addition to what Matt was talking about, just be thinking about how you want to exit, because a lot of times exits are involved in tax planning also, and you may have restrictions on when you can sell your shares and to whom you can sell them to.
Well, Joe, you mentioned a word that I just have to say, because I don't want to get away from it. Secondary. It's a consideration that's becoming more prominent right now. People need to be careful of the secondary sale of these things, because it could trip up QSBS treatment. So it's another thing to think about when you're exiting as a founder, you're getting some money off the table. It's a thing, and it's got to be part of your consideration in the secondary market.
Great. Rashad, what's your take?
No, I mean, I think it's interesting that, we kind of talked about the tax considerations. Frankly, if we look at the vast majority of the SPVs that get formed, they get formed as an LLC, and then for the first 3-5 years, there's really kind of no activity. But it does place the burden on the investor, because every year they have to get the K1s, they have to, kind of attach it to their filings, etc. So this is where, kind of the stuff that John was talking about in terms of the cost. Actually, a lot of the cost of the SPV goes into the annual tax, right? Generating those K1s and sending them out. So from the investor's perspective, I mean, for the first 3, 5, 7 years, depending how long they kind of hold that position until their distributions, etc., really, kind of, it doesn't make sense. It's more of an administrative burden for them to just kind of file the tax. To Joe's point about the secondaries, right? Whether it's SPV or directly in the company, those are kind of the structuring things, right? Some SPVs don't have it, some of them do. It's really kind of how you write the operating agreement of that vehicle, right, or the company that makes a difference. What's very interesting is that, you know, when there is a sale in the secondary market of that SPV, it could actually impose the burden on the taxation for the SPV administrator, because now you have a different valuation point, and then all of a sudden, you know, you kind of have to reset the partnership and just kind of do a whole bunch of other stuff. So the cost can escalate pretty quickly, right? Unless you kind of structure it in such a way that the SPV itself is a security and it trades in the secondary market without impacting the underlying holding of that SPV, right? So you don't sell an asset that SPV holds to redeem somebody, right? You can actually just trade the units of the SPV itself, which isolates and insulates all the other SPV members from any tax consequences, changing in the membership, etc.
Great. And
So
John, what would you take?
I think there's a couple of sort of definitions for the audience that we need to sort of highlight, right? Matt said QBS, or the qualified small business exemption, is the thing that ties to the 1202 rule, which allows a 0% tax for angel investors if you've held stock for 5 years. And so when we're doing LLCs and we're doing convertible notes, we delay a whole bunch of things in there. And so there's a mess that's being created in there around taxation for angels. The other thing that's worth paying attention to is that 60 to 70% of the companies are going to fail. They're going to go to zero, or they're going to go to something less than one. So there's a loss in there, and you would like to capture those losses. So when you're investing via your IRA, then all of a sudden that whole thing gets messed up. You can't carry the losses because you don't get to do that, right? So there's consequences about where the losses are that you need to pay attention to. So getting to stock early is a win for early angels, essentially, and keeping track of where the losses are, which means that you need to then, as an angel investor, figure out how to get enough volume of deals so there's something to write the losses off against. And so now we're in a volume game, right? And then the management of the 20, 30, 40 SPVs starts to be its own issue, right? Which is why we start looking at things like Carta as a mechanism to simplify that a little bit. So there's definitely room in the market for some organizing of how to build rational portfolios of SPVs in a way that lower the overhead.
John, alternatively, you could just not get into any losers. That would be the solution to that.
I believe the right answer to that is yes, dear.
Great. Ben, did you have anything else you wanted to say?
I would say for the founders, entrepreneurs on the phone, just know that your 1% and 2%ers, the investors that own small portions of your company, can be the absolute thorn in your side. So have good advisors, find an angel network or a group that knows what they're doing. They can add so much value to your world. And if you get a smattering of onesies, twosies that aren't sophisticated and aren't adding value, they will make your life miserable for the next 5-10 years. So, I mean, the takeaway for me is the SPV, the reason to do one from a founder entrepreneur is to aggregate some of the smaller investors, and that simplifies your life. And so you can have a 5 to 20% owner in an SPV as opposed to, 21% owners. And that'll make your life better if you do it right.
Great. And Joe, what are your final words there? Joe, you're on mute.
You're saying overall, right?
Right.
I think that if you're forming an SPV, because of the tax and the legal consequences, you really need to get good advice and make sure that you are working with people who understand these things and you have great advisors, because the complexity of them, their impact on how you operate, on how much administrative overhead you create, all of these things, you need an expert to help you. And so seek someone out who has experience with them.
Right. And Rashad, any final words from you? We're about to wrap up here in just a moment.
It's an interesting topic, right? It's actually, very popular these days to talk about the SPVs. But I think before, kind of somebody considers that, right, the primary thing is like, what are you trying to achieve and accomplish? So the tools should actually meet the objectives, right? And that's important to consider. I'll go to kind of John's point around the technology and kind of how it can simplify, the overall process. And let's just kind of forget for a second whether there's intermediary entity that aggregates the investors or whatever, because the paperwork will still happen, kind of no matter what. So, it's really kind of for the investors is to think about how to do it efficiently at the low cost, because there's a drag on performance no matter what you do. There's a drag on performance, and over a period of time it accumulates. And if you, as an investor, John, you mentioned like, investing in 30 or 40, expecting that one or two will win. Well, if you lose money on 30 and 40, all right, or 28, whatever, and they all have fees associated with them, compound effect of that can have a very negative adverse impact on the overall portfolio, right? So this is like, from the investor's perspective, you got to really kind of think about what is the most efficient way of doing it and structuring it. Is it, SPVs? In some instances, do you want to just go direct, right? If you can lower the cost and kind of provide the administration, do you want to go direct? And for the entrepreneurs that are looking to kind of get the investors in, again, sometimes it's an easy thing to say, look, I just want to go down to, an SPV. But frankly, all you've done at that point of time is outsource the administration of the investors to somebody else, right? So you need to kind of think about, how am I going to keep them happy so that they can communicate to their members, because the same pressures are going to apply on them that if the investors came directly to you. And not only kind of how I can keep them happy, but what is the compensation model, right? How do these people get rewarded effectively for the services that they provide, whether it's the installation for you versus, kind of those one or two people that Ben talked about. Like, what is that model, right? And make sure that, that is all kind of fairly well understood before, we all get carried away with the fashionable word SPV.
Great. I want to thank our panel today. It's been a great session. Appreciate everybody's experience, wisdom, and perspective. I want to thank the audience for asking great questions. We didn't get to all of them, but hopefully we'll in the future. And with that, we'd like to go ahead and close out the panel. And